why most beginners never start, and why 2026 is different. Most people don't avoid investing because they're lazy or incapable. They avoid it because the stock market feels overwhelming, risky, and intentionally confusing. Charts move fast, headlines sound dramatic, and everyone online seems either impossibly rich or painfully wrong. For beginners, this creates a quiet fear that starting at the wrong time, with the wrong knowledge, could permanently damage their future. For decades, investing was framed as something only professionals could do well. You needed insider information, expensive advisors, or years of experience just to participate safely. That belief still lingers today, even though the reality has completely changed. Many beginners are stuck fighting outdated ideas in a modern financial world that no longer works that way. Another reason people never start is analysis paralysis. They read articles, watch videos, and compare opinions until every option feels equally dangerous. One expert says buy now, another says wait. One says stocks are overvalued, another says inflation will destroy cash. Eventually, doing nothing feels safer than choosing incorrectly, even though inaction quietly carries its own cost. Fear of loss plays an even bigger role. Losing money feels personal, especially when that money represents years of hard work. Beginners imagine worst-case scenarios, market crashes, bad picks, or being the person who bought at the top. These fears are emotionally powerful, but they're rarely grounded in how long-term investing actually works. What most people don't realize is that the market has always rewarded consistency more than intelligence. You don't need perfect timing, secret strategies, or constant activity. You need a system, patience, and the ability to stay invested while others panic. That truth has been historically hidden behind complexity, jargon, and noise. So what makes 2026 different? Access today. Anyone can invest with minimal capital, low fees, and transparent tools. Information is no longer locked behind institutions. Data, education, and automation are available to everyday people, not just professionals. The barrier to entry has collapsed, even if the fear hasn't. Technology has also changed behavior. Automatic investing, fractional shares, and long-term index strategies have removed many of the mistakes beginners used to make. You no longer need to guess or trade frequently. You can build wealth slowly, deliberately, and almost invisibly over time. The biggest difference, however, is mindset. In the past, beginners were taught to chase performance. In 2026, the smartest approach is ignoring noise and focusing on process. Markets will always move up and down, but systems outperform emotions. Those who understand this early gain a massive advantage. Most Americans still believe investing is about beating the market. That belief keeps them stuck. The real opportunity comes from participating in the market consistently, not trying to outsmart it. When beginners understand this shift, investing stops feeling like a gamble and starts feeling like a plan. This is why most people never start, and why those who do it correctly now will quietly pull ahead. The rules haven't changed, but access, tools, and understanding have. In 2026, beginners don't need courage or brilliance. They need clarity, structure, and the willingness to begin. Starting doesn't require predicting the future or reacting to every headline. It requires accepting uncertainty and using it to your advantage. Markets rise because economies grow, productivity increases, and innovation compounds. Temporary declines feel dramatic, but over long periods, they become background noise. Beginners who understand this stop fearing volatility and start using time as their strongest asset. Time smooths mistakes, rewards discipline, and turns small, consistent contributions into meaningful results. In 2026, Waiting on the sidelines is more dangerous than entering imperfectly. Inflation erodes idle cash, while invested money has the chance to work for you every single day. The true risk is not learning how to start. Once that mental shift happens, investing becomes less about money and more about ownership in the future you are already helping to build. This section sets the foundation by replacing fear with understanding, hesitation with structure, and confusion with a clear starting point designed specifically for beginners ready to move forward confidently. It prepares the mindset required before any strategy, tool, or investment decision truly matters. Over decades ahead, consistently applied, the beginner's biggest mistake: trying to be smart too fast. Once beginners finally decide to invest, they often fall into a different trap, trying to act like experts before understanding the basics. They chase hot stocks, follow social media tips, and jump from one strategy to another, believing intelligence and speed will protect them. In reality, this behavior does the opposite. It increases mistakes, stress, and the likelihood of quitting altogether. The market doesn't punish beginners for being slow. It punishes them for being emotional. New investors often confuse activity with progress. Buying and selling feels productive, but frequent decisions amplify fear and regret. A stock goes down, panic sets in. A stock goes up, greed follows. This emotional cycle leads to buying high and selling low, the exact opposite of wealth building. Another common mistake is believing that investing success comes from picking the right stock. Beginners spend weeks researching individual companies, convinced that one perfect choice will change everything. This mindset is dangerous because it places all responsibility on a single decision. When that decision underperforms, confidence collapses, even if the long-term plan was sound. What beginners don't see is that professionals don't rely on single outcomes. They rely on systems. A system removes the need to be right all the time. It spreads risk, reduces emotional decisions, and allows consistency to do the heavy lifting. This is why diversified investing has outperformed most individual stock picking over long periods. In 2026, the smartest beginner strategy is intentionally boring. Boring means predictable. Predictable means sustainable. Sustainable means wealth has time to compound. Index-based investing, automated contributions, and long holding periods outperform excitement because they remove human weakness from the process. Beginners also overestimate short-term risk and underestimate long-term risk. They fear market drops, but ignore inflation silently eroding cash. They worry about starting at the wrong time, but forget that delaying entry often costs more than a poorly timed start. Time in the market matters more than timing the market, especially for beginners. Another mistake is copying advanced strategies too early. Options, leverage, and complex trading systems look attractive, but they magnify errors. These tools are designed for experienced investors with discipline and risk management. For beginners, simplicity isn't a limitation, it's protection. The goal in the early stages isn't maximizing returns, it's building habits. Learning how markets behave, how emotions respond to volatility, and how consistency feels during boring months is far more valuable than chasing gains. These habits create resilience, and resilience is what keeps investors invested during inevitable downturns. When beginners stop trying to be smart quickly and focus on being consistent instead, investing becomes calmer. Decisions become fewer, clearer, and easier to repeat. Confidence grows not from winning every month, but from staying invested through uncertainty. This shift separates those who dabble from those who build wealth. The market rewards patience, not prediction. Once beginners understand that their biggest advantage is not intelligence but time, they stop racing and start compounding. That's when investing begins to work quietly in the background, without constant effort, stress, or second guessing. Before you invest a single dollar, you need something more important than a brokerage account. You need structure. Most beginners rush to open an app, deposit money, and buy something immediately. That excitement feels productive, but without preparation, it turns investing into guessing. The first thing you need is financial stability. Investing should never come before basic security. If you're carrying high-interest debt, especially credit card debt, that interest is working against you faster than most investments can grow. Paying off toxic debt is often a guaranteed return, while the market is never guaranteed in the short term. Second, you need an emergency fund. Markets go up and down, sometimes sharply. If you're forced to sell investments during a downturn to cover rent or medical expenses, you lock in losses. A simple rule many follow is keeping 3 to 6 months of essential expenses in cash. That cushion protects your investments from your life circumstances. Third, you need realistic expectations. The stock market is not a fast money machine. Historically, broad US market returns have averaged around 7 to 10% annually over long periods. But that growth is uneven. Some years are strong, some years are negative. If you expect smooth, guaranteed returns, you'll panic when volatility appears. Understanding what you're actually buying also matters. When you purchase a stock, you're buying ownership in a business. When you buy an index fund, you're buying ownership in many businesses at once. This ownership mindset changes everything. You're not trading numbers on a screen. You're participating in economic growth. You also need clarity about your time horizon. Are you investing for retirement 20 or 30 years away? For a home in 5 years, the longer your timeline, the more volatility you can tolerate. Short timelines require more caution. Mixing these goals without a plan leads to emotional decisions later. Another critical piece is automation. Successful beginners remove willpower from the equation. Setting up automatic contributions ensures you invest consistently, regardless of headlines or mood. This habit builds discipline and reduces the temptation to time the market. Choosing the right account type is also important. In the US, tax-advantaged retirement accounts like a 401k or IRA can offer long-term benefits. A standard brokerage account offers flexibility. The right choice depends on your goals, income, and access through your employer. Most importantly, you need to accept uncertainty. No strategy eliminates risk entirely. The goal is not to avoid volatility, but to manage it intelligently. Markets fluctuate because economies fluctuate. That movement is normal, not a sign that something is broken. Finally, you need a written plan. It doesn't have to be complex. A simple statement like, I will invest $300 per month into diversified index funds for the next 20 years and not react to short-term news is powerful. Writing it down reduces emotional decisions later. Preparation may feel slower than jumping in immediately, but it creates confidence. When you know why you're investing, what you're buying, and how long you'll stay invested, market swings become easier to tolerate. Investing your first dollar is not the beginning of risk. It's the beginning of ownership. With stability, clarity, and structure in place, that first dollar becomes part of a long-term system instead of a short-term gamble.